Hey everyone, it's David here from Valorum. Just wanted to check in today to talk about why size and timing matters and how that can play a critical role in the final exit multiple that your business will get. So this is going to be just a little short one that's based on a couple articles I wrote, and I will leave the links in the description below. As well, just some administration here. So if you do like some of the videos that I produce, please subscribe to the channel. And I will also leave a link to our newsletter in the description below. So please sign up. Right now, that is coming out every other month. And that may turn into a monthly one somewhere as we move into fall, but I'm not 100% decided on that, but we'll figure that out. So a couple things I wanted to talk to you about. There's really two slides, and first off, I'll point out that these slides are courtesy of the Alliance of M&A Advisors, an organization of which I'm a member. And I think these two slides are incredibly important because they really outline, well, what sort of the M&A cycle looks like and has looked like over the last couple of decades. So here we've divided the transfer cycle into three different periods. There's the deal recession, which is a buyer's market. There's prime selling time, which is going to be a seller's market. And then there's a period of uncertainty, which, depending on where you are, could work for you, could work against you, but overall probably a bit of a neutral market. So what we've seen in the early parts of really the last 4 decades has been we've gone through an economic recessions, but we've also gone through deal recessions as well. So we've seen this in the 80s, 90s, 2000s, and 2010s. And this creates a buyer's market because what ends up happening is that, there's going to be obviously certain businesses that are, during a recession, you're probably going to have, the number of prospective buyers is going to be lower than normal. You're probably going to have businesses that are probably not generating as much optimal income as you would hope. And, the cross section of that is that you're going to have a situation where probably the valuation for many of those businesses is probably going to be a little bit lower than during the other sectors. And part of the reason too also could be just a perception of risk. So if you're in the middle of a lot of uncertainty, like in the middle of a recession, the buyer's perceptions of risk or uncertainty certainly would be higher than, during boom times when you've had, 4 or 5 or plus years of, really good results. So, and where are we right now? Again, we can't really predict the future. So we don't know if the next decade is going to work out exactly like this, but, we're just coming out of COVID. I'm here in Ontario and we just started opening up. So, and some businesses were not necessarily impacted very negatively by COVID and others were. So I think it's a bit of a bifurcated market right now, and that, some businesses, it's almost kind of like, they never really lost their stride. There was a little bit of a slowdown even for good companies in the early parts of 2020, but the second half of 2020 was pretty active. The first half of 2021 has been very active. In fact, it's probably going to be a very active year, and maybe even a record year. So if you've got a good business, you may not have really even felt the impact of any sort of recession. But we don't really know what's going to happen in the next couple of years. We don't know if there's going to be some some slowdowns due to hiccups, as we try to get out of this pandemic. So if you were a business that has struggled during COVID, but now kind of starting to pick things up, it's a good opportunity to, maybe start planning on, rebuilding your growth. And if you haven't thought about an exit strategy yet, maybe just start thinking about that. Because again, if you were impacted by COVID and you're trying to sell right this second in time, you may be in a situation where your business may not necessarily fetch the most optimal multiple. So that's something to keep in mind. So let's move on to the other sectors. So we, prime selling time has been traditionally sort of the middle of the decade. So usually about, the third year of the fourth year of the decade, which would be 83, 93, 2003, and 2013. And up until about, the near the end. So 87, 97, 07, and 19. So, and you'll notice that, the last decade, it was actually extended a little bit longer. So, and prime selling time is going to be basically, the economy's, going along well. The fundamentals of the overall economy are good. So if you have a good business, you're probably going to have a good opportunity to sell your business. And probably fetch a good multiple. And you may even see, as you move to the kind of the end of that prime selling time, again, depending on what kind of space you're in, you may even see, a bit of a frothy market. Now, it doesn't necessarily happen in the middle market that much, but, there's a lot of capital out there right now that's looking for returns. So we don't know what would happen. So, if the next decade follows along with what we've seen in the past 4 decades, the 2023 to 2027 period should be a good time. So that indicates to me that if you're somebody who has not started exit planning, that your window of opportunity really could be pretty strong starting into 2023. And the following kind of 5 years after that. So if you do have kind of 2 to 5 year plus time frame into exiting, that may be great, and it's a good idea to start thinking about exit planning now. Now the last segment is the uncertainty segment, and that's generally tends to be where either the market gets very frothy, or there's a lot of anxiety about maybe valuations, or, there's just some, sometimes what ends up happening is that the overall fundamentals of the economy start to deteriorate because, you've had a long expansion by this point in time. And so some of the fundamentals of the economy start to deteriorate. So, and usually the cause of uncertainty is going to be, different every time. Obviously, no one could have predicted COVID. The decade before, we had the financial crisis. In the 90s, there was a whole bunch of issues with, the long-term capital management and the Russian bonds, etc. There was a whole bunch of things that were going on during that period of time. In 87, there was the flash crash there, on the New York Stock Exchange there on October of 87, which led to a lot of anxiety. There was the savings and loan crisis at the end of the 80s. So there was a lot of, different things tend to be the impetus for what causes whatever the crisis is going to be. So we can't really predict what it will be. But there will be some period of time after that prime selling time where it's not going to be the ultimate time to sell. So it doesn't mean that you can't necessarily sell. It just means that, it may not necessarily be the most optimal time to sell. And, like last decade, that period of uncertainty was generally pretty short, and then led us into kind of COVID. So I think, you know, what you want to do if you're a middle market business owner, you want to, again, take a look at this from a very high level perspective and say to yourself, well, you can, if you want to go sell now, and you've got a good business, you probably have a decent chance of doing it. If you have a business that kind of struggled during a bit of COVID, it might be a good idea to maybe put off that exit plan and to move forward in a different direction. Maybe wait for a couple years for that prime selling period, and put together a definitive exit plan and value acceleration program. So that's that slide. And I want to move on to the second slide. So we talked about timing. So one of the other things that I wanted to kind of cover today is just talking about size. And the question is, why does size matter? Again, I'll just put the caveat here. These are some multiples for different businesses. These are EBITDA multiples and revenue multiples, but I tend to prefer EBITDA multiples for a number of different reasons. And I think the important thing to take away from this slide is that as you grow your business, there's a certain inflection point, and you can see it around that $20 to $30 million range, which is the deal size, so the enterprise value, where the multiples really can start to move up. So there's really this kind of like three or four different phases here. So you've got your, what I would call, almost kind of Main Street here, where you've got like, under 6 million and the multiples are in the fours, right? So we can see the multiples are in the fours. Once you get over, 6 million, from 6 to about 20, 6 to about 30 million, you're in the sixes in terms of EBITDA multiples. And then when you get above $30 million, all of a sudden the multiples really start to move up. So, from about 30 million to about 200 million, they're going to range between, 11, 12, 13. And then you get big enough. I mean, this is probably where you're going to get either really large private equity or you're going to get bought out by public companies. But you can really start commanding really large EBITDA multiples. So I will say the caveat: these are very generic multiples. So I'm not sure, you can't necessarily infer this into your business specifically, because every business is going to have different multiples, and so part of the exit planning process is to actually trying to figure out kind of where your multiple would be. So when we do evaluation, we're trying to figure that out. But this gives you a nice little high level analysis of kind of what, especially if you're like, if you were like running a couple $1 million, what's your incentive to maybe get into, that 7, 8, $10 million range plus, because all of a sudden now it's like, now your multiples are a little bit higher, right? And then the next level is going to be like that $30 million range where we can really start to get some higher multiples. And so the question would be like, why is this? Why does this relationship exist? Well, I think it's largely because the larger you get, the larger the number of buyers are going to be, and also those buyers are going to have more financial capabilities of making purchases than smaller businesses. So the problem, for example, would be like, for a business that's under $2 million, you're going to have a limited number of people, because a lot of those businesses are probably going to be, you got a solo investor perhaps, or somebody who's an entrepreneur but buying themselves a job, and they probably have limited resources in terms of debt, using debt to make acquisitions. So they're probably in a situation where you've got a limited number of buyers, and then a limited amount of credit that's available to them. So you put those two factors together, and it's gonna impact the pricing, simply because supply and demand. When you move to the next level, then when you start to get the $10 million range, like you're going to get more sophisticated buyers. You're going to get maybe strategic buyers. You might get some private equity involved, etc. And the larger you move along the way, the more you're probably going to see more strategic buyers who are looking for cash flow. Presumably, if you're in that kind of $30 to $200 million range, like maybe you've been a fast growing company, so that's going to be reflected in your multiple because the growth rate's part of that. And then once you get into a situation where you're really large, where it's like maybe a multinational wants to come by and buy you, or a public company, again, they have lots of currency available to buy you out. So again, that's going to impact the multiple in a positive way. So that gives you an idea. Like if you're in the lower middle market, it gives you an incentive to if you're in that kind of under $5 million range, gives you the incentive to move to that next level. If you're kind of in that let's just say $10 to $30 million range, gives you that incentive to move to the next level, potentially to grow it, because again, just the statistics say that your multiple is going to expand. So let's just kind of wrap this up. So I think in general, post-COVID recovery provides an opportunity to plan your exit. So if you are a business that was impacted by COVID, good time to sit down, think about how you're going to recover. And if you haven't thought about exit planning, then good time to do it. Waiting too long may produce less than optimal exit atmosphere. So if you're saying, I'll wait, 10 years, well, statistics say that we'll probably be in another one of those either recessionary periods or periods of uncertainty. So waiting too long may not be really the best idea for you. As we've seen, growth can produce enough size to open up your business to a new category of buyers. So, generally speaking, private equity, could be strategic buyers. And it's always important to remember, the more potential buyers, holding everything else constant, you're going to have a higher multiple. And it's just due to supply and demand. So, and let's finish off. What I always say is, if you haven't started exit planning yet, today is a great day to start, because exit planning is just good business strategy. So that's our little hit today. Look forward to talking to you soon with some more topics as we move into August.